attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series discussing NASDAQ listing requirements. To list its securities on NASDAQ, a company is required to meet both initial and ongoing continuing qualitative and quantitative requirements. The quantitative listing thresholds for initial listing are generally higher than for a continued listing, thus helping to ensure that companies have reached a sufficient level of maturity prior to filing a listing application. NASDAQ also requires listed companies to meet stringent corporate governance standards. Prior to submitting a full listing application, a company can seek a preliminary listing eligibility review. The Listing Qualifications staff will review the company's public filings to determine if it satisfies the minimum numerical listing requirements. The staff will also consider compliance with the corporate governance requirements of the marketplace rules. Once the preliminary review is completed, the Listing Qualifications staff will determine whether the company satisfies the numerical listing criteria and whether any corporate governance or other regulatory issues raised by the company would preclude listing approval. Any final approval, however, will still require the company to submit a formal listing application and undergo the full review of the NASDAQ Listing Qualifications staff. Moreover, any final approval will require satisfactory compliance with certain other qualitative reviews, including a review of the regulatory history of the company's officers, directors, and significant shareholders. For the NASDAQ capital market, there are three financial and liquidity standards of qualification. These are the equity standard, the market value of listed securities standard, and the net income standard. All three standards require the company to have a minimum of 300 shareholders owning at least 100 shares each and a minimum of 1 million shares in the public float. Generally, all three standards require a stock price of $4 over a 90-day period. However, there are exceptions that allow for either a $3 or even $2 price based on higher revenues, assets, and operating history. All three standards require a minimum value of stockholders' equity. The equity standard requires $5 million in equity with 2 years operating history, while both the market value and net income standard only require $4 million in stockholders' equity and no particular operating history. Though the net income standard does require $750,000 in net income for the last fiscal year or 2 of the last 3 most recently completed years. All three standards require a minimum market value of the public float. For the equity and market value standard, it is $15 million, and for the net income standard, it is $5 million. The market value of listed securities standard requires a $50 million market value, while the other two standards do not require any particular market value of listed securities. A complete chart and summary of all of the listing requirements is available on my blog site at securitieslawblog.com. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.